In recent years, the global financial landscape has increasingly focused on sustainability, driven by growing environmental concerns and the need for responsible investment strategies. Green bonds and sustainable investing have emerged as pivotal tools for financing environmental initiatives and aligning investment practices with long-term sustainability goals. This detailed video Green bonds, sustainable investing, the key features, benefits, challenges, and the broader impact on the financial markets and society. Before starting, don't forget to like and subscribe to our channel for more future updates. Green bonds. Definition and characteristics. Definition: green bonds are fixed income securities designed to raise capital specifically for projects that have positive environmental or climate benefits. They function similarly to traditional bonds but are earmarked for financing green initiatives such as renewable energy, energy efficiency, clean transportation, and sustainable water management. Characteristics: use of proceeds. The primary characteristic of green bonds is that the proceeds are allocated exclusively to environmental projects. Issuers must clearly outline how the funds will be used and provide transparency regarding the environmental benefits of the financed projects. Certification and standards. Many green bonds are certified by third-party organizations to ensure they meet specific environmental criteria. Common standards include the Green Bond Principles, GBP, established by the International Capital Market Association, ICMA, and the Climate Bonds Standard, CBS, from the Climate Bonds Initiative, CBI. These certifications help maintain credibility and trust in the green bond market. Reporting and transparency. Issuers of green bonds are typically required to provide regular reports on the environmental impact of the projects funded by the bonds. This reporting ensures accountability and allows investors to track the effectiveness of their investments in achieving environmental goals. Types of green bonds. Use of proceeds bonds. The most common type, where the funds raised are allocated to specific green projects. The issuer commits to using the proceeds for environmental purposes and provides regular updates on the impact. Green securitizations. These bonds are backed by a pool of green assets, such as renewable energy loans or energy-efficient mortgages. The cash flows from the underlying assets are used to repay the bondholders. Green bonds with project-level reporting. These bonds are linked to individual projects rather than a general green initiative. They provide detailed reporting on the performance and environmental impact of specific projects. Sustainable investing. Definition and principles. Definition: sustainable investing, also known as socially responsible investing, SRI, or ESG, environmental, social, and governance investing, involves incorporating environmental, social, and governance factors into investment decision-making. The goal is to achieve positive financial returns while contributing to sustainable development and responsible business practices. Principles. Environmental considerations. Sustainable investing takes into account environmental factors such as climate change, resource depletion, and pollution. Investments are evaluated based on their impact on the environment and their contribution to mitigating environmental challenges. Social factors. Social considerations include factors such as labor practices, human rights, and community impact. Investors assess how companies manage social issues and their contributions to social well-being and equity. Governance aspects. Governance factors focus on the quality and integrity of corporate governance. This includes evaluating board composition, executive compensation, and transparency in reporting and decision-making processes. Investment strategies. Negative screening. This strategy involves excluding companies or industries that do not meet specific environmental or social criteria. For example, investors may avoid investing in companies involved in fossil fuels or tobacco. Positive screening. Positive screening focuses on selecting companies with strong ESG performance or those that contribute to sustainable development goals. This approach seeks to invest in businesses with favorable environmental and social practices. Impact investing. Impact investing aims to generate measurable social and environmental impacts alongside financial returns. Investors actively seek opportunities that address specific social or environmental challenges, such as renewable energy projects or affordable housing initiatives. Integration. ESG integration involves incorporating environmental, social, and governance factors into the overall investment analysis and decision-making process. This approach considers how ESG issues affect financial performance and risk. Benefits of green bonds and sustainable investing. Environmental impact. Green bonds and sustainable investing play a crucial role in financing projects and initiatives that address environmental challenges. By directing capital towards renewable energy, energy efficiency, and sustainable infrastructure, these financial instruments contribute to reducing greenhouse gas emissions, conserving natural resources, and promoting a transition to a low-carbon economy. Diversification and risk management. Investing in green bonds and sustainable assets can enhance portfolio diversification and risk management. Green bonds are often issued by governments, corporations, and development banks, providing a range of investment opportunities across different sectors and geographies. Sustainable investing strategies can help identify companies with strong risk management practices and long-term sustainability, potentially reducing exposure to environmental and social risks. Positive social and economic outcomes. Sustainable investing can drive positive social and economic outcomes by supporting businesses and projects that promote social equity, improve community well-being, and create employment opportunities. For instance, investments in clean energy projects can lead to job creation in the renewable energy sector and stimulate economic growth in local communities. Enhanced reputation and investor demand. Companies and institutions that issue green bonds or adopt sustainable investing practices often benefit from enhanced reputation and increased investor demand. Investors are increasingly seeking investments that align with their values and contribute to sustainability goals. As a result, businesses and governments that embrace green finance can attract a broader base of socially conscious investors and strengthen their market position. Challenges and limitations. Greenwashing. One of the major challenges in the green bond and sustainable investing markets is greenwashing. Greenwashing occurs when issuers or investors make misleading claims about the environmental or social benefits of their products or investments. To combat greenwashing, it is essential to have robust certification standards, transparency in reporting, and independent verification of environmental impacts. Lack of standardization. The lack of standardized definitions and criteria for green bonds and sustainable investments can create confusion and hinder market growth. While initiatives such as the Green Bond Principles and Climate Bonds Standard provide frameworks for green bonds, there is still no universally accepted standard for sustainable investing. Standardizing definitions and metrics can improve market clarity and facilitate better comparisons between investment options. Measurement and reporting challenges. Accurately measuring and reporting the environmental and social impacts of investments can be challenging. Quantifying the effectiveness of green projects and sustainable investments requires reliable data and methodologies. Enhancing data collection, impact assessment, and reporting practices is crucial for ensuring transparency and accountability in the green finance sector. The future of green bonds and sustainable investing. Growth and innovation. The green bond and sustainable investing markets are expected to continue growing as awareness of environmental and social issues increases and investor demand for responsible investment options rises. Innovations in green finance, such as new types of green bonds, ESG-focused financial products, and advanced impact measurement methodologies, will drive further market development and expansion. Integration of climate risk. Climate risk is becoming a central focus in financial planning and investment strategies. The integration of climate risk into investment analysis and decision-making processes will become increasingly important. Financial institutions and investors will need to assess the potential impacts of climate change on their portfolios and develop strategies to mitigate climate-related risks. Alignment with global sustainability goals. Green bonds and sustainable investing will play a key role in achieving global sustainability goals, such as the United Nations Sustainable Development Goals, SDGs. Investments that address climate change, promote sustainable development, and advance social equity will be critical in achieving these goals. Financial institutions, governments, and investors will need to align their strategies with global sustainability objectives to drive meaningful progress. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.